Hi, everyone, and welcome back to another episode of the Enough Club. I am Brian Nicol,
I'm Pieter and
and today we're going to be finishing off our three-part series in the cost of investing. You might remember in episode 1, we talked about the cost of investment management rather, so how much that actual fund or the ETF costs. Then in the next episode, we talked about administration and any other costs. And today we're talking about advice costs, how the advisors can get paid. And this all comes back to the initial terminology we use to frame this three-part series, which is understanding your effective annual cost, or your EAC of your investment. If you're not sure what I'm talking about, please go back 2 episodes and listen from there. Effectively, what we're looking at is how much does it cost to invest as a South African investor, whether you are a DIYer or not. If you are a DIY investor, today's talk won't necessarily relate to you too much because we're talking about the advice fee. That's the one row in the EAC table. It's one of 4 rows, and there might be a percentage there for the advisor. So in South Africa, there are various ways an advisor can earn. So to break the few ways down for us, I'm going to hand over to Pieter.
Thanks, Brian. Yes, so when we look at the EAC, the advice fee that we see there is usually based on a AUM model, assets under management, meaning you've got an advisor appointed on your investment portfolio, and based on kind of what you've negotiated with the advisor, there's most likely a tiered fee scale that's being applied. And let's say you've got first 1 million rand is 1%, the next 2 million rand is 0.7%, and then 0.5%, 0.3%. And your advisor will then earn a percentage of the value that you've got invested with them. And if your investment portfolio increases, they earn more. If it decreases, they earn less. And this is typically what you'll find in the effective annual cost. In South Africa, the vast majority of advisors earn their fees through this model. It's also very popular overseas. It's the model that is most prevalent. There are other types of fees as well, ways that advisors could generate revenue. And I'll probably just start off by saying the way that an advisor earns a fee does not necessarily correlate to how good or bad the advisor or the advisory firm is. The way they charge is based on their own views on how to build a business and how to generate revenue. And the way they generate that revenue could be different, many different forms. What is most important that we want to get across today is understanding different ways that you could pay an advisor, and more so understanding what exactly are you paying in rands and cents, not in percentages. And then for you to decide the value that you receive from the advisor that goes beyond just picking funds, because financial advisors are not synonymous with investment managers. Yes, they can help you put together a portfolio, but we are beyond the days where financial advisors' value should only be focused on choosing funds. Now, for you, it's important to understand, how do I equate a percentage or different levels of fees into rands and cents, and then know, all right, Mr. Advisor sees me once every 3 years, or once a year, or 3 times a year. This is what he or she is doing for me. Does this make sense to me? The value that I'm receiving, value always needs to exceed the fees. And as long as that happens, that's okay. You've got a good relationship. But more often than not, what we see is there's a mismatch. Either you are paying way more than you should, or that you are even aware of because you don't know what you're paying because you don't see it, or you are paying a fee, but the value is not really there. There's not really a relationship going on. It's more like a transactional thing. So let's start off with AUM. That's probably the easiest way to quantify. So you've got a amount invested with your advisor. You've got, let's say, a retirement annuity, and it's 1 million rand with the advisor. They charge a 1% fee. You are paying 10,000 rand per year to the advisor. Now, what happens in the back end is the fund manager, the platform that you are invested on, they will deduct that percentage every month from your investment portfolio. That will get paid over to the advisory firm, and the advisor will earn that fee. So again, it's a percentage, and it's usually applied on a tiered scale. What you need to go and do is quantify And it's an easy mathematical equation. You multiply the percentage by the amount being invested with that advisor, and then see, all right, this is what I invested. Sometimes you'll have different investments with different types of advisory fees, but that is one that I'll start off with. That's the most common one. You also get commission-based advisory fees. Now, we've spoken a lot about this in the previous episode when we covered the admin and the other fees. This is how typically when an advisor sells you a policy-based investment and they receive upfront commission on that investment. Now, what we mentioned last time is it's usually quite a large amount being paid out to an advisor, and the platform or the insurance or investment company, they don't really pay that fee. What's happening is that fee is being recouped from your investment portfolio at a very high fee percentage in the initial couple of years, and that gets paid over. So commission-based advisory service levels, that fees that were earned, that was usually what existed in the past. For the most part, that has been phased out, but there are still products in the market that get sold by this, and just be very careful. If an advisor tells you it's free, then they're either lying, because no one works for free, or if they tell you that they are being paid by the product provider, it could be the AUM model, a percentage of the commission, or if that's zero but they receive an upfront commission, you need to understand what that will mean for your portfolio, typically very high fees in the beginning. That is typically what we refer to as product-based fee models. So Brian, maybe expand a bit on the difference between product-based and client-based, and then take us into the next group of fees that we can pay.
When we talk about product-based fee models, it's really the advisor is getting paid based on the fact that a product exists, the fact that you've taken the product out with them. So the assets under management you talked about, or the AUM fee, they're only getting paid that because there are assets that they help manage. There's investments with their investment provider of choice. And so that is linked to a product. And so it's product-based. And commission is if they sell you an insurance product or something like that. That's product-based as well. Then you get the client-based. And so client-based is something that is negotiated directly with you, which isn't related to the advisor actually managing your portfolios. And so that might be a flat fee, a retainer, a specific rand amount that you're going to pay the advice firm or the advisor individually to provide you with their services and to add value to your life. So we refer to that as client-based because it's, you may or may not implement products with that advisor. It doesn't matter. And so at our firm, where Pieter and I work at Freedom Financial Planning, we work on a flat fee basis. In other words, clients, we present a fee to them, we negotiate it, and that rand amount is what clients pay us on an ongoing basis for our services, or once off when they maybe purchase a wealth audit from us or an hourly consultation. The fee is not attached to a product specifically. So, we don't say, okay, well, we'll only get paid once you invest money. We try to deconflict things as far as possible at Freedom Financial Planning. And so we don't have that necessarily in our firm, but our way of doing things, kind of the client-based fee, is by far the minority in South Africa. Now, the client-based fee that you have, if you negotiate a specific fee with your advisor, that will not feature on the EAC table because the advice fee is not attached to the product. And so that would be probably a big fat round zero. And then your administration, investment management, and other would be the rows that are populated with a particular percentage point. So the product-based, you're getting paid because a product was sold, which is, I think, approximately 90% of the local advice market. And then you get the client-based, which is more a fee that is negotiated, a specific rand amount that you can pay the advisor in any way, shape, or form you choose. Just something, though, that is a bit of a misnomer, though, is that in South Africa and around the world, actually, in financial advice, the term assets under management came about. It was inherited from the investment sector. A lot of what we do is actually inherited from the product providers themselves, because they're the ones that actually invented financial advice. And so you look at the AUM fee, it's often utilized as a way to say, we don't charge commissions, we earn AUM. Advisors often say that. And a case study that I can give you is an exact situation that happened with a client of ours. We were still in the prospect phase, so they weren't a client yet. And they kind of told me about the advisor that they have, and they talked about how they found out how the advisor gets paid, and they said the advisor told them that they do not earn commissions; they get paid a professional fee. That was the wording they used. So they worked with this advisor, and then a while later they said, I've never discussed this professional fee with the advisor. Let me find out how much I'm paying. And so they asked the product provider for a statement, and they got their EAC. And then they saw there was a 1% advice fee being charged. So they spoke to the advisor and said, you told me there's going to be a professional fee, and now you're earning commission from the investments. And they said, no, it's not commission. It's a professional fee from your investments. But they said, how is it not commission? How does it work? And they said, well, all the money you kind of place with us as an advice firm, we place a percentage on that and we get paid that. To which the guy said, that is the most perfect explanation or definition of commission I've actually ever heard. And so that guy left that advisor because he felt, in his words, he says, I felt really stupid. I felt like I'd been duped. So there's obviously, you can have different ways of earning as an advisor. Our job is not to try and pick that apart and say which is better or worse for you. That's up to you to decide as the listener. What I will say, though, is that regardless of how we go about charging for our services, you have to be firstly transparent. And secondly, the client, you as the consumer of the advice, must understand what the person is actually talking about. And so they might say, we have an AUM fee, and you think, what is AUM? I mean, I drive a BMW and my cell phone network is MTN. And, what is AUM? I don't know. And so we need to, as advisors, I suppose, we need to make sure people understand, because I firmly believe that when it comes to these types of topics, transparency means absolutely nothing without comprehension. If someone doesn't understand what you're saying, you could have just spoken Latin to them. And so that is why it's important to just break it down. And if you're sitting with the advisor, you say, I don't understand, just slow down, just break it down for me, explain how this all works in layman's terms. Then you can decide, I'm happy to go along with this. I'm happy to work this way with you. I understand how it works, whatever the model is. And I'm hunky-dory with that. So that's just something important to mention. Pieter, what is your kind of take on the trend in terms of fees for advisors locally and then globally as well?
I think if you kind of look at the evolution of the financial industry, you alluded to it earlier, when financial advice was born, it was created, it was out of a system where it was products, it was distribution of products, product supplier agents. It was companies that created financial products. They needed people to sell it. They appointed these agents, and that was kind of what financial advice meant back in the day, the selling of products. Now it has evolved over time. The industry has turned into a profession, or I'd like to refer to it as a profession, where now you can actually go and study to become a qualified financial planner, a certified financial planner. There's a whole degree where you do financial planning. Now, there's a distinct difference between financial advice and financial planning. Financial advice is tied to a product. It's the recommendation or the termination or the variation of a financial product like insurance or investments. Financial planning is the analysis that's being done. It's encompassing a whole process of starting out, understanding the needs of the client, doing a quantifiable analysis, and then at the end, matching the advice to the product, giving advice. So it's like going to a doctor, right? You don't go to the doctor, you've got a sore leg, and once you enter through the door, he's starting marketing all of the different anti-inflammatories on the market, and hoying you with a bunch of tablets, and now you choose one and you go off. There you go. No, he starts off by asking you questions, understanding what happened, how long has it been going on, doing a clinical examination, running diagnostics, and then at the end say, all right, these are probably three things that's going on. This is my recommendation, 3 treatment options. I recommend this one. Here's a script. Go to the pharmacy, get your medication. That is advice, the script and the pharmacy. But the whole process of getting to that point is the financial planning aspect, is the analysis. So why am I saying that? Because in the beginning of the industry, that was the selling of products and commission was paid out. That was the model that existed at that time. The industry has evolved where advisors felt like, this is not right. We don't want to get paid that way, because then Charlie Munger, used to say that, show me the incentive, I'll show you the outcome. If the incentive is the selling of products, you will always have a transactional relationship with someone, because they're only incentivized to sell you something in the beginning and not incentivized to maintain the relationship because they're not getting paid. So then the industry evolved, and the AUM model was born, where it was now, let's align incentives with the client's investments. If I get paid from the investments, then I'm incentivized for them to do well, because then I will do well. And then there was a step further where advisors were like, we also don't fully agree with that, because it's not always so transparent, and we can't really determine what the markets will do. Us as financial planners do not know what the markets can. We can't predict what's going to happen, and for our fees to be dependent on what the markets do is not really that aligned. All right, so let's now convert it to a rand amount that you pay us based on complexity. So if you have a very simple estate, it's cheaper. If you have a very complex estate, it's more expensive. And that is the model that I think we all really understand. Because if you go to the doctor, you pay a consultation fee. You pay for the medication. You pay for the follow-up. You don't pay an ongoing amount of what your medication balance is per month. It doesn't work that way. So when we look at the totality of the markets, I can not speak for everyone all over the world, but the vast majority of financial advisory firms still focus on the AUM model. Some still do the commissions, and the flat fee model is still small, but it is gaining rapid traction, in developed markets like the US, UK, Australia. And even here in South Africa, on our home soil, there's a kind of, our firm is doing that, a couple of other firms as well. Still very new, still pioneering this new way of doing business. There's no handbook or guidelines to really how to do it. We're trying to absorb whatever is out there in the world and contextualize it to a local market. But it is growing rapidly. And again, I'm trying to go back to my point, is we are not saying as a firm, this is the best way or the only way. What we are trying to say is there are different models. And I think especially in a South African local market, we've got a very dynamic ecosystem of different levels of wealth. We've got very rich individuals and we've got extremely poor individuals. And we need all of these types of remuneration models to exist to help people at different levels of the ecosystem. So what is most important is just understanding the way that you engage with an advisor if you decide to use one. And I think at the end of the day, for me, as a consumer, but also as an advisor, it's important for the consumer to have the option to choose how they would like to be served and to what extent. Because some people are happy to pay with their investments. That's cool. They understand it. They know the fee they're paying. They're happy. There's no problem. Others might be more DIYers. They've spent time to educate themselves. They know how investments work, but they also know enough to understand that they don't know everything. And they would like to have someone to just look at everything, tell them if they're on the right track, help them identify blind spots. They will never want to pay an AUM fee because it doesn't make sense to them. It doesn't resonate with the way they think. So they might be more suited to an once-off like project. Look at everything, tell me what to do, off I go. Or sometimes it's even as far as like, I just have one specific question on this one specific thing and that I can't get the answer. I want to engage with someone like I'm going to the doctor and I pay for the hour. So it's not one is better than the other. It's just there are different ways that consumers can be served. And I'm hoping to see as a collective industry, a profession in South Africa, that these different models will start to become more prevalent, that firms also start to adapt to that. Because I do think, like case in point, if you only have a firm that only works on the AUM model, it is quite expensive to give advice, right? Because it's a highly regulated industry. You have to take clients through a very specific process that takes a lot of time, a lot of overheads. So just to take on a client is expensive. That means you need to pay, you need to generate enough revenue to at least, break even, be profitable. And that means that fee needs to come somewhere. And if the only model is AUM, then you're going to have a minimum amount of investments that someone has to have to take that fee from them. So that excludes a massive portion of the market of your young professionals that earns very well, but they don't have large assets because they're paying off a house, they're paying off student loans, they've got other priorities right now that's not tied to long-term investments, and they'd be happy to pay a fee. It's just not through their assets. They can pay through an EFT, and that's what we try. That's kind of what we saw. Is like, who's helping that group of people, and building the infrastructure to support that. I think that's, again, giving the consumer the choice of what works best for them. And I would say, as if I have to put down the numbers, in South Africa, it's probably less than 1% on the retainer model, probably 90% AUM and the other 9% commission based. I'm really like sucking numbers out of my thumb here. I don't know for sure the stats, but I do see the future where it is going to start balancing out a bit more towards the kind of retainer hourly project based, but probably AUM is going to dominate for a long time, because also the way that the industry has been born and developed is built on that infrastructure where the advisor gets paid through the product provider, and that's kind of how most firms decide to work with. And but again, it's more so for the consumer to decide what would make sense to them, and to then accommodate them at that level.
Exactly. So that's kind of I think quite a thorough breakdown of the different components of that one line item of the EAC, the advice, how you could be paid. If there is a percentage there, now it's either in the form of commission or assets under management. When it comes to investments, once again, something you can add to the checklist of rubbish products. And so if the advice figure is above 1.15%, that is 1% plus VAT. If it's above that on your EAC, you're in a rubbish product. Okay. Now, if you don't know what I'm talking about, the previous episode, I talked about how you know if a product's rubbish. This is one of the ways it relates to the advice fee. How do I know that? Well, because the thing is that when it comes to assets under management, when it comes to investing, you can legally only charge up to 1% excluding VAT on investments. That is a regulatory thing. Advisors can't really charge more. However, commissions, which is semantics, but commissions, they can go above that. They can go 3-5% maybe. And so if it's above 1%, it's a rubbish product. And so now that is the final kind of line item for the EAC, the advice line item. And we'd love to hear from you maybe in the comments as well. You can put it there. How are you paying for advice if you are advised? Or if you are looking for an advisor, how would you pay? What are your experiences as well paying for advice? What's kind of the best and all the worst things you've seen on advice fees when it comes to your investments on the EAC itself? We'll be interested to know. Get some discussion going in the comments field. And please reach out to us if you have any questions about any of this as well. I know it's like a super technical thing, but at the same time, we want to make sure you guys understand what it is you are getting yourself into, what the dynamics of your relationship are. And for us at Freedom, as we have mentioned before, we work on either a retainer or we work on a fee for a project. It's always going to be a rand amount that we negotiate with those clients. A lot of our friends and colleagues in the industry charge on AUM or commission. There's a model that suits everybody. I think, go find the people you want to be with and work with if you are looking for advice, and look at the one that kind of suits your situation as well. Before I close off, just any parting thoughts from you, Pieter?
Yeah, I think, again, the message we're trying to get across is just transparency and understanding, having clarity. First of all, the background knowledge, what to look out for. So we've now covered all of the different 4 components of the EAC, and then just having a bit of knowledge around how to interpret it, what is normal, what is not, and then for you as the viewer to then use that information to make an informed decision as to, on a fund level, on an admin platform level, on an advisory level, this is what I'm paying in rands and cents per year. This is the value I'm receiving. Does that equation make sense to me? Am I getting enough value for what I pay? If so, perfect, you're in the right place. If not, maybe a time to go and look at, revisit everything and make sure you you get to a point in life where you are paying for what it's worth. Because I mean, that's how everything in life works, right? You're paying a fee for a service or a product that needs to add value to your life and that needs to make sense to you. And if you don't understand the fee, or if you ask for an explanation of a fee and you don't get a proper answer, that's usually not a good sign. Luckily, with the internet and ChatGPT, we have all of the tools we need to further dig into this. But I hope that this series has enlightened some of you to know what to look out for, and to provide some context of what we would refer to as reasonable, and as Brian refers to it, the rubbish list that you want to rather avoid. So thank you so much for tuning into this series. We appreciate your time and that you're listening to us, and please let us know in the comments what type of advisory fee model you'd prefer, and which one you'd like to see in the industry evolving over time.
Awesome. Thanks a lot, guys. Thanks for tuning into the Enough Club, and we will speak to you soon.
Awesome. Cheers.